Welcome to FinSights Daily by Finvestin, where we cover the daily updates from the world of finance that impacts your day-to-day life. I'm your host Narendran. Quick reminder, play this episode at 1.5x for a better experience if you are short on time. In today's episode, we are going to see three major stories that's going to affect our investment and daily budgeting. First, global trade wars. Second, educational inflation. Third, the sweet news from our own banks, that is, loan interest rate reductions. Coming to the first segment, as we have been discussing in the past 1 week, the global trade wars happening between nations, majorly US and China. The financial landscape is shifting dramatically as the US has imposed a staggering 145% tariff on certain Chinese imports, citing persistent trade imbalances and intellectual property concerns. This is not just another policy announcement, it's a financial earthquake with aftershocks that will reach our investment portfolio. China has responded forcefully, escalating retaliatory tariffs on US origin goods from 34% to 84% effective from 10th April. This tit for tat exchange has sent global markets into a tailspin, with Dow Jones plummeting over 2,180 points intraday before partially recovering. Similarly, significant drops have occurred across the S&P 500 and Nasdaq 100 in US. For Indian investors, this creates a complex yet potentially lucrative landscape. Let's break down what this means for our money. First, if you are invested in export oriented Indian companies, particularly in textiles, pharmaceuticals, electronics, or IT services, you might be sitting on potential gold mines. With Chinese goods facing prohibitive tariffs in American markets, Indian exporters are uniquely positioned to fill this gap. Consider reviewing your portfolio to increase exposure to these sectors, especially companies with established US market connections. Second, the global supply chain realignment represents a once in a generation opportunity for India. As multinational corporations frantically diversify manufacturing away from China, India stands to attract substantial foreign direct investment. For retail investors, this translates to potential growth in Indian manufacturing stocks, infrastructure players, and industrial real estate. However, beware of the heightened market volatility. This trade tensions creates significant uncertainty that could impact global demand and investor confidence. Now might be the perfect time to ensure your portfolio has sufficient diversification across asset classes. Consider increasing your allocation to defensive sectors and perhaps even gold as a traditional hedge against geopolitical uncertainty. Talking about more asset classes and diversification, we will be having a detailed episode on these diversification and asset classes in the upcoming Wealthier Way series. Coming to the next segment, the education cost crunch. While navigating international trade dynamics, Indian families are simultaneously facing a domestic financial challenge, skyrocketing education cost. Recent data from local circles reveals that nearly half of Indian parents have seen their children's school fees increase by 50 to 80% in just 3 years, a financial burden that's forcing many families to cut essential expense or take on debt. This educational inflation far outpaces general inflation, creating a financial planning emergency for families. The regulatory framework offer little protection with only a handful of states like Maharashtra and Tamil Nadu implementing effective fee control measures. For families facing this financial squeeze, here are simple strategic approaches to consider. Start your education investment journey today, not tomorrow. The power of compounding means that beginning even a modest education fund now can yield significant results. For instance, investing just 5,000 monthly in SIP with a 12% annual return can accumulate approximately 10 lakhs over a decade. Implement a structured budgeting using 50-30-20 rule. Allocate 50% of your income to necessities, 30% to discretionary spending, and 20% to savings and investment. Within this framework, carve out education funding as a non negotiable expense category, treating it with the same priority as housing and healthcare. These rules doesn't consider to be a hard and fast rule. You can find out your own rule which adapts your own personal finance. But this rule any rule is to have a disciplined approach to your budget and saving mentality. And also, don't overlook negotiation possibilities with educational institutions. Many schools offer early payment discounts, sibling concessions, or merit based reductions that go unclaimed simply because parents don't ask. A 5 to 10% reduction might not seem substantial, but compounded over years of education, it represents significant savings. Beyond personal finance planning, explore scholarships and financial aid programs. Many private foundations and corporations offer education grants that receive surprisingly few applicants. Education loans should be approached as a last resort and when necessary. Carefully compare terms across multiple lenders to secure most favorable rates and repayment options. Always, I would suggest go for a debt free education that gives you a free mindset to your children in the future. Amidst these macro challenges and financial crunches comes a financial opportunity. Four major government banks, Punjab National Bank, Bank of India, Indian Bank, and UCO Bank, have reduced their lending rates by up to 0.25% following the RBI's decision to cut repo rate to 6%. This creates an immediate action opportunity for borrowers. If you have a home loan of 50 lakhs with a 20-year tenure, this seemingly small 0.25% reduction could save you approximately 3 to 4 lakhs in interest payments over the loan term. Here's where the strategic financial thinking becomes crucial. When your bank reduces its lending rate, you typically face a choice between lowering your EMI while maintaining the same loan tenure or keeping your EMI constant while reducing your loan period. That is nothing but the number of years of your loan. The conventional wisdom suggests that reducing your loan tenure is financially optimal as you will become debt free faster and save significantly more on interest payments. However, in our current environment of investment opportunities stemming from the trade war or realignment, the lower EMI route offers intriguing possibilities. By reducing your EMI and systematically investing the difference in high potential sectors positioned to benefit from US China trade tensions, you might potentially generate returns that exceed your interest savings. Consider directing these funds towards SIPs in sector specific mutual funds focused on manufacturing, export oriented business, and technology. These rate cuts don't automatically apply to your loan. You must proactively contact your bank to request the application of the lower rate to your existing loan. Set aside this time a week to call your relationship manager or visit your branch armed with questions about both EMI reduction and tenure shortening options specific to your loan. The interplay between global trade tensions, domestic education inflation, and monetary policy shifts creates both challenges and opportunities for Indian families. Those who approach these dynamics with strategic planning rather than reactive decision making will not only weather potential economic turbulence but potentially emerge financially stronger. By understanding how these macroeconomic forces affect your personal finances and taking deliberate action, whether reallocating investments, optimizing loan terms, or prioritizing education funding, you position yourself to transform economic challenges into financial advancement opportunities. Remember that in times of economic uncertainty, those who combine informed action with strategic patience typically realize the greatest financial gains. Stay vigilant, be proactive about these financial opportunities. Position your family for prosperity despite the challenging economic landscape. Well, that's all for today's Finsights Daily. Thank you for joining me. This is Naren signing off. I'll see you on the next episode with fresh updates from the world of finance. Have a wonderful day and remember, stay financially savvy.